Welcome to The Bell, a spirited conversation for thoughtful investors. I'm Adam Johnson in New York, Tom Esses in Florida. Hey Tom, the Olympics were fun, but I guess now we're back to Trump, Yellen, and Jobs. What are you watching this week?
Well, I'll tell you what I'm watching. I'm watching that it's the end of summer, thank God. I think we're going to start to get some resolution on what's been creating a really dull market.
So I tell you what, we've got a lot to talk about today. We're going to be joined by Kyle Woodley, who is the managing editor of Investor Place Media. These guys get 1.5 million unique views per month. It's like one of the largest retail investor websites in the country. First, I want to get to our order book, the three things that you and I are all fired up about. Oil everywhere. The Dow theory is dead. Transports don't matter anymore. And the Fed is gone fishing. So you start us off with oil.
You got it. Oil everywhere, yet still the price goes up. All the talk about a ceasefire, all the talk about a global production or cap, basically, has pushed oil up on momentum. But the fundamentals throughout that period have gotten worse. You got a Nigerian ceasefire, you got Iraq pumping more oil, you got more fracking production coming out of the U.S. So sooner or later, this has to resolve itself. This is not a fundamentals-driven rally, Adam, and that's the major takeaway here. And in the end, fundamentals win out, and it's an important thing to realize, even though oil is trading well short-term.
I am so sick and tired of all the talking heads trying to put a label on this thing. We're in a bull market. We're in a bear market. Stop.
It's crazy.
You know, guys are calling it a bull market because we were up 20%, $8. Whoop-de-doo. We're down from 120. Give me a break. The one thing you mentioned that I think is really key, fracking sand up like 17, 18%. So guys have figured out how to be profitable with oil under $50. That's a big deal.
Yes, it's a very big deal. Technology keeps getting better. The marginal price of oil keeps going lower. It's not a fundamental bull market.
No, it's not. All right. Fundamentally, Dow theory is dead. Transports don't matter anymore. And I got to give the guys, by the way, at Strategas Research Partners credit for this one, Jason Trennert and his whole team. They point out the fact that in the olden days, when we were an industrial economy, if you make stuff, you got to transport it. Because we are now a service economy, 70% of our economy is service-based, transports really don't matter. And what we should instead be watching is the cloud. So they're saying that the cloud is like the new transports indicator.
You know,
what do you think of that?
You know that a bunch of tried and true Dow theorists just kicked over their computer screen right now. Right, hearing this heresy.
They are angry, and I will get hate mail.
You will, but it's a very good point. I mean, listen, the economy has changed. You know, it really has, and indices have to change with them. There's no question about that. I mean, there are old rules, but things are changing.
Honeywell is now going to start employing not traditional engineers, but electrical engineers. I mean, it's all about software and programmers.
It is.
And that's the whole point.
Absolutely. It is. But, you know, one thing that is still consistent, still hasn't changed, and is not changing anytime soon, is the Fed is still dovish. And, you know, we got Jackson Hole this week, and there is some worry that Yellen is going to come out and she's going to say, listen, maybe we will think about raising interest rates sometime this year, basically echoing what Fisher and Dudley et al. Said last week. That's almost certainly not going to happen. Yellen is a tried and true dove. We all know it.
She's a total dove, and I would even argue that Stanley Fisher, whom I used to interview at Bloomberg all the time, a lovely guy, I think that they're effectively setting him up in the same way that they used to set up Alan Blinder opposite Bernanke, to effectively take the other side when, in fact, the boss is still in charge, and they're not going to make any changes.
No, they're not. And in fact, part of the reason you're seeing bond yields a little bit heavy this week and the dollar a little bit heavy this week is people are front-running a dovish speech on Friday. She's never used a speech to imply a rate hike is coming. I doubt she's going to do it on this major one.
Give me a break. And by the way, the yield 140 to 160 is the most consistent range we've seen out there. It's like the euro trading at 112. All right, we got to bring in our boy Kyle.
Absolutely.
The man from Investor Place Media. Kyle, thanks for joining us today.
Happy to be here.
You know, I said it right at the top of the podcast that Investor Place Media gets 1.5 million views per month. That's 50% more than New York Times. Where do you get all these people?
Most of the people that come by are your stereotypical dividend buy and hold investors. We do actually have a decent trading crowd, but most of the people that come in on a day-to-day basis, they want to know about REITs, they want to know about Dow Jones stocks, things that you can hunker down in for, 20, 30 years, and just be comfortable in retirement.
So, Kyle, one of the things that I've been talking to a bunch of investors around here is this sort of movement to a point away from stocks and into ETFs and or mutual funds. And it seems like there's even a migration from mutual funds to ETFs among the self-directed investor. Are you guys seeing that? Is there a trend you can really describe there, and what's happening in that sort of corner of the financial product marketplace?
everything is going into ETFs. Mutual funds are growing a little bit, but ETFs are growing a lot. That's been the case for years, and that's going to continue to be the case for years for a myriad of reasons. As far as individual interest goes, when it comes to the long-term buy and holders, I actually think that there's something of an underrepresentation there. A lot of people that are looking, say, 20, 30 years in the future, they don't think about ETFs as necessarily the right vehicles for them. And it doesn't mean that they're not. It just means that they're sort of set in the idea that it's still AT&T, it's still GE, it's still these long-term plays. And they think that ETFs often can just be, levered products, things that are, just traded around a lot. But the reality is that a lot of ETFs are actually good for, buy and hold retirement investors too.
Hey, speaking of levered funds, Kyle, what do you make of all these levered ETFs, and why are these things even legal at this point?
These are trading products. That's why they were designed. If you go and take a look at their at any levered funds prospectus, you see that these are just meant for very, very short swing trades. That's what they're there for. The problem is, of course, is that any stock and ETF isn't limited to just traders. Anybody can go and get them. End of the day, it's just all about personal financial responsibility. Whenever you're going to buy something, you need to read about it first. And so that's where everything sort of comes on us. We just try to make sure to educate people and let them know. A double dividend fund or a 3X biotech fund, it sounds great. You can get triple the returns. You can also get triple the losses. So just know what you're buying. Know what you're buying before you jump into them. That's all.
Smart beta, however, is one of these kind of new concepts that's crept into it. And as I understand it, smart beta effectively, rather than just using an index, it tries to use some sort of screening data, factor data, whether that's dividend yield, whether that's earnings growth, etc., weave that into a strategy and pick names accordingly. Kyle, your take on smart beta ETFs?
So smart beta, while the term itself is still sort of the new hotness, smart beta has been around for years. If you have, say, a dividend fund like Vanguard Dividend Appreciation, if you have the DVY, if you own an ETF that says Russell 1000 Value or Russell 1000 Growth, any of those ETFs that again have been around for years, those are smart beta. Now it's just becoming more of a marketing term. People like the term. Index funds have been around for a while. People are familiar with that. So what they want now is a way to beat the index funds. They want something that's better than index funds. And so now you hear it's smart beta, you're like, oh, somebody's thinking about a way to do the index better. With a smart beta fund, there's actually not active management. What you're doing is you're taking a basic index, so say the S&P 500, and then you're slicing and dicing it in 1, 2, 3, or more ways to create something of just a better index. So for instance, you might take the S&P 500 and only include stocks that have a dividend above 3%. That right there, something as simple as that makes it a smart beta fund.
So I'm kind of thinking we need some 3L action. What do you say, Tom?
Oh, I think it's about that time.
About that time. What have we learned? What are we looking forward to? And what do we love? All right, Kyle, we're going to put you on the spot, but I'm going to make it easy for you because I'm going to go first. What have we learned? I'm calling this one Brick and Mortality. Walmart and Sears and Kmart, between the three of them, effectively shutting 175 stores. There was some data out this morning that effectively explains why online retail now accounts for 8.7% of all goods sold in this country. I'm blown away by that, Tom.
It's a seminal shift in how people spend their money.
Yeah, totally. What am I looking forward to? I'm taking Friday off. Look, I just launched Bullseye Brief, like in May, and I got to work. I've been working all summer, and I'm finally taking a day off. My summer vacation is I'm going shooting with a couple of buddies on Friday. Details to follow. And as far as what I love, I know this sounds a little crazy, but I'm saying it anyway. I love the fact that Speedo and Ralph Lauren told Ryan Lochte to take it elsewhere. They basically fired the guy because I'm sorry, you cannot go to a foreign country, represent the United States, and do whatever he did in that gas station. We'll probably never really know. Vandalism, get on a plane and leave your teammates behind to explain it. I'm sorry, doesn't fly. So adios, Ryan Lochte, and I compliment and I salute Ralph Lauren and Speedo for saying so.
Cheers to that. I couldn't agree more.
All right, Kyle, you're up.
No, what we just learned this morning is that Best Buy is really hard to keep down. Best Buy is up nearly 20% today. just obliterated earnings expectations. Fitbit and GoPro are actually getting a little bit of ride out of it too. Amazon's coming. At some point, Amazon's coming. Amazon's been coming, but Best Buy refuses to stay down. Best Buy is probably one of my favorite charts to look at, because just looking at how the price actually reacts versus the narrative, which is to say the narrative has been for 5 years, 10 years that Best Buy was going to zero. 2013, it certainly looked like we were going to get there. Now it looks like Best Buy is at least figuring out a way to stay relevant, which is a lot more than I think anybody, bet on them to do by this point. Looking forward to Sears earnings here in a couple of days. It's a dumpster fire.
Looking forward? Are you short? Are you short?
No, sometimes you just like to, pull up a chair, watch a dumpster fire. It's entertaining. I'm actually predicting that Eddie Lampert is going to say that they're going to start selling off clothes hangers and office staplers, just basically to make ends meet. It's the clearance sale that won't stop until Sears is finally gone. I'm interested to see how the market reacts on Thursday. And what do we love? Low volatility. The ticker is EFAV, and it's an iShares minimum volatility developed market fund. If you take a look at most international ETFs, you're going to see a lot of up, you're going to see a lot of down, and if you take a long enough look, you're just going to see essentially a range-bound straight line. EFAV, at least so far, again, through just a few years of existence, it's actually a slope upward. For most of the time it's there. It's slinging off dividends.
All right, I guess I'm up. All right, what did I learn today? I learned that I need to be careful of REITs. So a couple things we said today made me think about that. Number one, they have received the most amount of inflows throughout the year, which tells me they've absorbed a huge amount of capital. But we're talking about major store closures across the United States. We're talking about Sears closing stores, talking about Macy's closing stores. That makes me a little nervous for some of these REITs that are dependent on malls, that sort of thing. Are they going to have the tenants there as we see this continued huge shift from people going into a store to actually just buying things online and staying home? Also, Adam, you'll be happy to hear this. Apparently, New York apartment rental rates have peaked.
Yes.
It's starting to actually head lower. So I'm a little bit nervous about REITs here as far as an incremental destination of capital. That's what I learned. What am I looking forward to? I'm looking forward to college football. 1 week from Thursday, I will be in Nashville to cheer on the Vanderbilt Commodores, my alma mater. SEC guy, and we play the hated South Carolina Gamecocks on ESPN at 8 p.m. to kick off college football season. Very much looking forward to that. And then what do I love? I think I'm in love with SPHD. Makes some yield with low volatility.
Tom, your website.
www.sevensreport.com. Spell it out. There's a free 2-week trial. We send you a macro note every morning you can read in 7 minutes, and it's delivered to your inbox by 7 a.m. Eastern.
And Kyle, again, one of the most sought-after, followed websites by retail investors in this country, 1.5 million views. Investor Place Media?
www.investorplace.com. And if throwing that into your browser bar every day gets a little bit tiresome, we actually have a set of free e-letters that go out every day. Some just have normal, just like a normal set of the most popular stock picks. We have an ETF e-letter that comes out every week, a retirement-specific one, and a dividend-specific one. So you don't necessarily have to get everything that the hoi polloi gets. You can go ahead and say, this is what's right for me.
All right, beautiful. Well, you certainly have us covered. I am, of course, Adam Johnson at Bullseye Brief. My email, AJ@BullseyeBrief. Tom, have we wrapped this thing up?
I think so. I think we provided enough value here to get us a little time off.
I think we have. All right, I'm going shooting on Friday. You have a great time next week when you go back to Vanderbilt. And Kyle, as always, thank you, sir. That was very insightful.
Thank you.
All right. Adios, gents. See you later.
Take care, guys.